Right, here we go, folks. Earnings reviews for week number 2, the week that was. And what a week it was. Absolute insanity. And the reason is we got a divergence where earnings were telling one story while the action of the market was telling another. The action of the market, gamma squeezes, short squeezes, stampedes on call options. The eyes of market participants were glued on what the Fed is going to do, what the Fed is not going to do, the pivot is coming, all eyes on the Fed. But ladies and gentlemen, those eyes missed on what's actually going to move the stock market and the economy in the next few months. It's the fundamentals, stupid. At the end of the day, Fed or no Fed, the fundamentals will dictate where this stock market is going to go and where the economy is heading to. Hint, how about the dumpster? Now, I know a lot of viewers don't like these kind of videos. This is boring, Maverick. Earnings reviews, who cares about that? That's fine. Close the video, skip, go back to Pornhub. But don't come back to me crying a few weeks later or a few months later and say, hey, Maverick, you never cover the fundamentals. I don't know what stocks to buy. Why is the stock market up? Why is it down? What's going on with the economy? Everything is being told and predicted by these earnings. All what you have to do is establish a trend and follow what these trends are going to lead to. And you know exactly which stocks to buy, which stocks to short, where the stock market is heading, where the economy is heading to. Now, last week, we got a lot of earnings. We're not going to cover all of them. We're going to cover some of the most important earnings that came out last week and some of the names that I happen to be involved in because a lot of you follow that. So we're going to do Tuesday last week. We're going to do Verizon, 3M, Lockheed Martin, and Microsoft. And from the earnings that we got last Wednesday, we'll do Boeing, US Bank, ServiceNow, Tesla. And then from the earnings of last Thursday, we'll do Southwest Airlines, ADM, Valero, Blackstone, Visa, and Intel. And lastly, from last Friday, we'll do American Express and Chevron. Now, if you've been following my earnings season coverage, you know that I've been looking at 3 things. Number 1, what is the impact of the recent drop of the US dollar on earnings? So far, and you're going to see from week number 2, we haven't seen the impact yet. The impact remains negative, meaning in the next quarter, we're going to start to see the impact of the recent drop in the US dollar on corporate earnings. Now, is it going to happen too late, meaning the margins, revenue decline, net income decline? Will all of that overshadow the positive impact of the decline in the dollar? Or what if the dollar rebounds before we even enjoy the recent drop, meaning the Fed comes out hawkish, but we see the dollar rebounding anyways? Then that cancels whatever optimism we had based upon the recent decline in the dollar. Number 2, what I'm looking at, what is the impact of the recent consumer weakness on sequential revenue growth? Now, in the majority of the earnings that we got last week, we don't have to look at sequential growth because the year-over-year story alone is telling enough. And perhaps the most important point I'm looking at is, as inflation cools, are corporate revenues dropping faster than expenses or vice versa? If expenses are dropping faster, so far, so good, we have a soft landing ahead. But if corporate revenues are dropping at a faster rate than their expenses, then we got a recession ahead. Are you paying attention or not? Because that leads me to another point that I should have added here. If corporate expenses are holding ground a lot stronger than revenue growth, then that means we're going to see layoffs. So what I'm looking at in these earnings, what are the prospects of layoffs in each particular company? Because if we establish a trend by looking at multiple companies' earnings, and we find out these companies need to cut jobs to balance their margins, then we got a problem here in the economy. So keep that in mind. Now let's start by Verizon and see how that report looked like. To begin with, operating revenues were up by 3.5% year over year. Now what about expenses? Expenses were up by 5.9% year on year. So right off the gate, we got a problem here because expenses are rising at a faster rate than revenues. Now we know in a company like Verizon, which is technically a utility company, they have limited avenues in increasing the revenue stream. They can, of course, increase prices on consumers, but that could cause a backlash and we see a lot of consumers switching to other providers. So that's a no-go. In other words, what I'm trying to tell you here is Verizon would need to lay off some employees. You know how Barack Obama said, hey, we tortured some folks. I'm sorry, but a lot of companies will have to lay off some folks. I'm just telling you what the numbers are saying right now. I did not make the rules. I'm just telling you what's going to happen in the economy based on these numbers. You're going to see the trend, not just in Verizon, but many other companies. They have have to get rid of a lot of employees because revenue growth has stalled. Expenses, on the other hand, not so much. Now, when it comes to the net income for Verizon, up 41.4% year on year. Now, you might say that this is an impressive number, but there was a recalculation of pension funds, whatever. So the reason behind the bump in net income year on year was technical in nature. It wasn't due to any fundamental reason at all. And now, just to solidify for you why Verizon need to cut some jobs, we will look at the consumer segment of Verizon, which is the most important one. Operating revenues up 4.2% year on year. Expenses rising by 7.6% year on year. Which category in expenses rising the fastest and the most? The answer is, how about the headcount? Selling, general, and administrative costs, that is up 13.8% year on year. They're gonna have to lay off employees, no doubt in my mind. And right away, we see the operating margin for the company down from 28.6% last year to 26.3%. Again, a good operating margin, but the shareholders of Verizon will say, hey, you want me to continue to invest in your company? I like the dividends, but you, Verizon, will not be able to sustain this generous dividend without laying off employees to improve your margins. You gotta cut down some expenses. And unfortunately, this will come with a lot of folks getting fired. Next, we have 3M, one of the most abysmal reports I have seen so far this season. Why do I say that? Look at sales down 6.2% year on year. On the other hand, costs are rising by 17.6% year on year. Absolute insanity here. No wonder why. The bottom line for the company, the net income is down by stunning 59.6% year on year. And the operating margins down from 18.8% last year to 7.8% this year. Again, no wonder why we got the news that 3M is laying off a lot of employees. What is the problem here in 3M? We know that their expenses are too high. They have to get rid of a lot of employees. But why are sales down to this magnitude? We have to dig in the categories, and when we do that, right away we notice that the dollar is a problem here. Can that be fixed by the recent drop in the dollar? Perhaps, some of it. But the problem in 3M goes beyond the dollar. Yes, the currency impact shaved off 5.3% from the safety and industrial category, 6.2% in transportation and electronics, 4.5% from healthcare, 3.1% from consumer segment, and all in all, the currency impact was a negative 5% for 3M. But the bigger problem here is sales are declining across the board. Sales all in all down by 6.2%. For safety and industrial down by 4%. Transportation and electronics down by 5.9%. Healthcare, the thing mania is over now. Sales are down 6.7%. For the consumer segment, sales down 10.4% year on year. These are not good numbers for the company at all. Now, can they increase revenues at this stage? Can they do that by raising prices? That's a no-go. I mean, the numbers are saying demand is down. Are you going to increase your prices on top of that? That's a no-go. The only avenue that 3M has for now to improve margins at all is to lay off employees and cut down on expenses. This is not a good dynamic for any stock to be in. You don't want to be in 3M right now. They got a big problem. They need to fix it. They need to improve margins and then come back in another report. And if we see improvement, then we should buy 3M. But right now, this is an abysmal report. Stay away from 3M. Toxic waste. Now, what about Lockheed Martin, a company that I own? And it did respond positively to the report, so let's see if it's good or not. Before we start and look at the report, perhaps an important catalyst is Lockheed is now saying, hey, if Ukraine needs planes, the F-16s, we're ready to go here. We just need the government to say, go ahead. And folks, let me tell you something. All the talk right now about the tanks, we know in modern warfare, tanks are absolutely useless. You ever heard of drones? You can fly a drone and take an entire row of tanks easily. So this whole let's send tanks is absolutely stupid. It's not going to change anything at all. So what is the next step? It's pretty much in the bag right now. They're going to send Ukraine these fighter jets. Now, the consequences are dire, World War III, nuclear war. But until the nuclear party starts, we know this is going to be a positive catalyst for Lockheed. We can make money out of it. If the oligarchs, the warmongers, the deep staters are making money out of it, let's make some money too. It's about time the little guy gets a cut. But anyways, when we look at net sales, up 7.12% year on year. But the cost of sales, up 9% year on year. So right off the gate, we got a problem here at Lockheed. The operating margin for 2022, fourth quarter, of course, down from 14%, now 12%. And therefore, net earnings down 6.68%. The bottom line, negative 6.68% year on year. So we got a problem here in Lockheed. And your question might be, hey Maverick, what is this? Why is the stock up? These are not not good numbers. Hold your horses. When we look at aeronautics, which is the top segment for Lockheed, the OM, which is the most important metric I look at, it is down from 11.5% from 2021 to 10.7% last year. Now, when we look at the segment of missiles and fire control, the operating margin actually improved year on year from 13.6%, to 13.7%. So that's good. The problem is in aeronautics. When we look at rotary and mission systems, the operating margin also improved from 10% of 2021 to 10.6% in 2022. Now, for the space segment, the OM is down from 10.5% in 2021 to 7.1% in 2022. Now, we know this is a new segment. A lot of investment has to go through. So this is understandable that we have a squeeze in operating margin. This is not a problem at all here. So why were investors happy with the results of Lockheed Martin? The answer is, look at the backlog. For aeronautics, up 15.3% year on year. Missiles and fire control up by 6.34% year on year. The rotary and mission systems up by 3.7% year on year. Space up by a little over 16.4% year on year. And the total backlog is up by around 11% year on year. In other words, what investors see is Lockheed doesn't have the problem of expenses rising significantly higher, meaning they don't need to get rid of employees. They need employees. They have a significant amount of backlog here, but they need to charge more. So it's just a problem of charging more. With the war going on, with the demand sky high from Germany, Norway, Sweden, Japan, all of them, that would be a no problem at all. Lockheed can charge more, no problem here. Revenues will get balanced with the expenses. The net income will move higher again. And therefore, investors like this report by Lockheed, not because what happened before in the rearview mirror, but what's about to come in the pipeline. Not to mention the fact that the valuation is pretty good and the stock is down big year to date. Now here's yet another important report that we got last Tuesday from Microsoft. Let's see if these numbers are good or not. Because the stock initially went up, then came the conference call, the stock went down and then went up again, and now it's down all over again today. So let's see what the numbers actually say, so you don't have to go back and forth and get your head smacked on the way up and the way down chasing calls and puts. The numbers are telling you a story. The trends are telling you a story. And based on that story, you're going to bet one way or the other. Now we know that the currency impact is really important and significant for Microsoft. It is a giant multinational company. A lot of revenue comes from overseas. Now, when we look at the revenue growth year on year, it was 2%, but absent of the strong dollar, it would have been up by 7%. The operating income was down by 8%, but if the dollar did not move higher, absent of the strength of the dollar, operating income was pretty much flattish at 0%. Now, the bottom line for Microsoft, the net income was down a stunning 12% year on year. Absent of the strength of the dollar, it would have been down anyways, but by only 4%. So here's the question for you. Let's say the dollar, now it went down, we might see that impact in the next report. Would that be enough to rescue Microsoft? Because even absent of the dollar altogether, the bottom line would have been down 4% either way. So this is something you got to keep in mind. If you're just betting that the dollar going down, that will be good for revenues and net income in the next report, that is my thesis beyond buying Microsoft right now, you got to keep in mind that the fundamentals got a lot worse, that the growth story in this company is slowing down markedly. But just to illustrate for you the negative impact of the dollar, let's look at different segments here, the big ones for Microsoft. The cloud revenue, that was up by about 22% year on year. It should have been 29% year on year, but the dollar shaved off 7%. And the same goes for Office 365 commercial. The dollar shaved off about 7% worth of revenue growth here. The crown jewel of the company when it comes to growth, Azure, the revenue growth should have been 38% year on year, which is impressive. Yes, it is down from previous quarters, but still a good revenue growth here. But it only grew by 31% because the currency impact shaved off about 7%. When we talk about Xbox, the currency impact took off about 4%. It should have been negative 8%. It went down by negative 12%, and the reason is the dollar took off 4%. Devices, we know there's a major slowdown here. Absent of the dollar, revenue should have been down 34% year on year, but the reading that we got is down 39% because the dollar took off 5% worth of earnings here. But folks, dollar or no dollar, we have a major problem in Microsoft, as I'm going to show you right now. The revenue growth all in all year on year was 2%. The cost of revenue growth was up by 3.11%. So right off the gate, we got a problem here. The cost of revenue is growing at a faster pace than the growth in revenues. We'll look at expenses. Research and development up 19% year on year. Sales and marketing up 5.5% year on year. And look at this. This is stunning. General and administrative costs up 69% year on year.
Oh my God!
wonder why Microsoft is laying off employees? And this is just the beginning. They need to lay off thousands of more employees because the bottom line was negative by 12.5% year on year. And look at this. You see the trend right in front of you. In green, we have revenue growth year on year. It is declining. But look at the gap between the decline in revenue growth and the decline in blue, which is net income growth. The gap is huge. Why did this gap open big time for Microsoft? The answer is the cost for the headcount in the company skyrocketed. And therefore, yes, the company's revenue is slowing down. But the bottom line, the net income, the profit is down even by a larger magnitude. And the reason is expenses are skyrocketing. This is a major problem. You see the illustration right in front of you. I don't need to say anything more here. Microsoft will have to get their margins back in order. The easiest way they can do that is by laying off a lot of employees. Now, in the last quarter and in Q2 2022, for example, it wasn't clear the trend in the deceleration in revenue growth. But now it is clear. Now we know that revenues are going down. The management sees that, and therefore they're pulling the trigger and cutting expenses by getting rid of employees. And as we see more and more companies realizing that, hey, we know we got a problem with employees and the headcount, we overhired and overpaid. We know that. But for now, our revenue growth is still intact. We need these employees to continue to maintain the revenue growth in the company. But the moment they see the revenue growth decelerating, that is the moment when these companies announce layoffs and get rid of all of these employees to reduce their expenses because revenue growth is going down. Why is it going down? The end consumer is not spending anymore. We go back to the intro of the video. What I'm looking for in these earnings reports, the consumer is not spending in Microsoft anymore. They're slowing down the spending, be it the individual consumer, be it the commercial consumer. Now the company looks around and says, okay, then we don't need all of this expense. We don't need all of these employees. And until they get their margins in balance, the stock, in my opinion, is not investable. We need to see another report where the dollar improves these margins. We see them getting their expenses back in order. Then we're talking. But even if that happens, will the deceleration of revenue growth continue? Because that is the major headwind here. That is the main one. Anyhow, last Wednesday we got Boeing. Let's look at that one. Right off the gate, Boeing says, look, the operating margin for the commercial airplane segment, which is the main segment for Boeing, that was negative by 6.8%. But last year, it was negative by 93.8%. So we have a major improvement here. And by the way, look at the revenue growth. We went from $4.8 billion in Q4 2021 to $9.2 billion in Q4 22. And I say that's cute, Boeing. That's a nice attempt. But let's compare the numbers from Q4 22 with the numbers of Q4 2018, before the thing and before the flying coffin MAX 737 problems. When we do that, the $9.2 billion revenues in Q4 22, that's actually down by 44.24% versus the number that we got in 2018. So nice try, Boeing. I'm not convinced here. Look at the defense, space, and security segment. The operating margin is improved from negative 4.4% to positive 1.8%. Now, with that being said, we got a problem with this unit. I'm going to talk about it in a minute. But before we do that, what about global services? Perhaps the most lucrative business segment from Boeing. The operating margin was positive last year by 9.3%. They improved on that last year, I should say, by 13.9%. Now, the question becomes, why are investors excited about Boeing stock? What's going on with the stock BA moving higher, sky high? Why are people buying the stock right now? The answer is perhaps they see the light at the end of the tunnel, that the problems that we've seen with the company since the flying coffin disaster, the 737 MAX, we are finally seeing the cash flow turning positive again. It was negative by $20 billion in 2020. It was negative by $4 billion in 2021. Last year, it went positive finally by $2.3 billion. Now, here's the problem for the flying coffin. Revenues up by 7% year on year, but expenses up by 6.47% year on year. So we have the rate of revenues exceeding the rate of growth in expenses. So far, so good. But the problem is, even with that, the company is experiencing a net loss that increased by 18% year on year. Now, why did that happen? The answer is, when we look at the operational expenses, they moved significantly higher year on year. For example, when we look at the growth rate in research and development expense, you don't see it here, but it was up by 27% year on year. That is contributing to the bottom line of the company being down by more than 18% year on year. Now, can Boeing solve the problem by getting rid of employees? Of course not. Can they solve the problem by reducing their expenses on research and development? development? Of course not. They have a lot of competition here to deal with. And that makes the stock really hard to buy here. How can you improve the margins? How can you improve the net income of the company from being negative and turn it positive again? Can you cash in more orders from overseas? We have a global recession coming. I'm not sure about that. Can you improve the margins by getting rid of employees? Of course not. You have a lot of backlog. So unlike Lockheed Martin, where the problem can be solved easily by just charging more, and you got the demand white hot from Japan, from Germany, from Turkey, from Greece, from Saudi Arabia, from all of these countries. You got no problem as a company increasing prices and charging more. On the other hand, with Boeing, it becomes more challenging just to charge more at this point because you have contracts, they're fixed, the majority of orders are already in the backlog, and the future demand environment is really challenging when we have a global recession coming. Unlike a defense business when you have a war going on in Europe right now. Enough said, let's move on to US Bank and see what's going on here. Now, the consensus is when we have rising interest rates, you gotta stick with the regional banks versus the big banks. In this case, you stick with US Bank versus JP Morgan because they benefit more from interest rates. While this is a good assumption, in reality, the rise in interest rates is a double-edged sword because it increases revenues, but it also increases expenses for the company, as you can see right now. And this is really stunning, by the way. The interest income for US Bank went higher by 78% year on year, but the interest expense also went higher by 524% year on year. Now, the ratios don't mean anything. It doesn't mean that this is bad because the interest expense for the company is really small compared to the interest income. Now, here's the problem. The non-interest income for US Bank actually went down year on year. What is the number one segment contributing to the drop in revenues year on year for non-interest income? Look at this. Mortgage banking revenues. With the rise in interest rates, the housing market was frozen. It's kind of heating up right now with the rumors that the Fed is pivoting and yada yada, but the damage has been already done. The mortgage banking revenue for US Bank went down by 65% year on year. Bruh. Unbelievable. And you wonder why Wells Fargo is bailing out and saying goodbye? They don't see things improving. Now, when it comes to the non-interest expense for US Bank, look at this. Compensation and employees' benefits up by 7.65% year on year. And therefore, the net income is down a stunning 44.57% year on year. Oh my God! Now, what is the problem with this company? The answer is clear. The mortgage banking revenue slowed down by a lot. If it doesn't heat up, then the bank will be forced to lay off employees. For now, this is not the immediate solution, but the bet has to be that mortgage banking revenue will improve and recover. If it doesn't, then we got a major problem here. Next, we have ServiceNow, and this was actually a good report, and just a fun fact for you, I used to consult for this company back when it was a baby, when Fred Luddy was leading the pack here, and it was a decent company back then. It's no wonder why it grew to what it is right now. And immediately, the moment it went public, I bought shares in ServiceNow because I knew what was happening in this company. Anyways, it is a good report, but we have a problem, and the problem stems from the overvaluation of the stock. So the company itself doesn't have a problem right now. The stock has a problem of overvaluation. When we look at the subscription revenue, it is up by 22% year on year. Last year, the growth was 21%. While it is positive growth year on year, it is only 1%. That means that the subscription revenue growth slowed down by a lot. I mean, this company used to produce double digits, triple digits in subscription revenue growth. Not anymore. So we're seeing a slowdown here. You can see it clearly. It is a negative trend. Q4 21, actual growth for subscription was 29%, then it went down to 26% in the next quarter, then 25, then 22, and now it's kind of flattening at 22%. Still a decent growth rate, no problems with that at all, but we have a slowdown here. Furthermore, when we look at the headcount for the departments of the company, it's increasing, meaning expenses are rising, subscription revenue is stalling. Is it alarming right now? Not in the immediate term. But could it be a problem in the long run? The answer is absolutely yes. For now, the operating margins are pretty good, 28% in the last quarter. No problems here, actually an improvement over last quarters. So this is pretty good. The management is doing a pretty good job in this company. And they're doing so by keeping expenses in check. Now look at this. Revenue's up by 20% year on year, but the net income is only $150 million, meaning that the net profit margin is only 7.73%. It's a good number, but it's not good for software. So what happened here? We dig into the details, and once again, revenue growth about 20% year on year. The cost of revenue up by about 10.6% year on year, and most importantly, operating expenses up by 13.8% year on year. So we know that the growth rate in revenue is exceeding the growth rate in expenses and the cost of good, or in this case, the cost of service. In other words, if you happen to be an employee at ServiceNow, you're probably underpaid. Just keep that in mind. But the result of you being underpaid is pretty good for the bottom line of the company because it did report positive bottom line and it was up by 577% year on year. So among the software cohort, this is a company that's actually still doing pretty good. No wonder why the CEO was on CNBC last week and he said, "We're seeing all of these layoffs in the tech and software businesses, not in ServiceNow. We're actually hiring. We're actually looking for employees." And the numbers are confirming all of that. Now, how long can ServiceNow maintain the subscription revenue growth? That's up for grabs. You need to see a lot of damage in other companies before they start canceling their subscriptions in ServiceNow. Otherwise, this revenue stream is predictable and it is dependable because it is a subscription. You only get hurt two ways. If you're not acquiring new subscriptions, and that could happen because we have a global slowdown. Number two, if some of your current subscribers get hit really hard and they have to cancel, they have to go out of business. Now, that's not foreseeable for now, and therefore I do like ServiceNow. The problem is the valuation is bad, so I like the company, not the stock. And here it is, Tesla, the souffle, the talk of the town. Now, the stock is up, 100%, 200% since the report came out? That's due to a gamma squeeze. That's not due to the fundamentals at all. With that being said, the fundamentals are pretty good. Tesla continues to report stunning numbers when you consider the fact that it is an automobile manufacturer. But there is one alarming trend that I'm going to show you in a minute. Step by step, automotive revenues up by 33% year on year. Stunning. The all-in-all revenues up 37% year on year. Absolutely stunning. Once again, this is an automobile manufacturer. We're not talking about a software company here. But notice that Tesla has the tendency of not showing the cost of goods sold, perhaps for good reasons. More on that in a minute. But operating expenses are down by 16% year on year. Look at that. And therefore, the operating margin is actually 16%. That is an impressive OM for Tesla. All in all, the net income is up by 59% year on year. But the problem is, the free cash flow went negative by 49% year on year. Why is Tesla bleeding cash? We go back to the conversation of the cost of goods sold. They're hiding it for a reason. They're paying more for batteries. They're paying more for aluminum, for copper, for the machinery. And of course, you look at this report, you're not seeing the cost of goods sold. But you can see the gross profit, which calculates the cost of goods sold. Now, when we do that and we establish a trend for the gross profit, look at what happens. The gross profit is dropping like a stone in Tesla. Q4 21 and was up by 135%. Q1 22, which was the peak, up by 147% year on year. Then it started to go down big time as expenses rise and revenues decline. And with the recent price cuts, the gross profit will get even worse. It went down to 47% in Q2 22. Then it maintained the same ratio, 47% in Q3 22. But in the latest quarter, Q4 22, look at this, down from 47% to 19%. Now, 19% is an impressive number for gross profit. Make no mistake at all. The problem becomes the growth in the company and the margins in the company decelerating big time. Now, why is this a problem? Because the stock valuation is way, way overvalued, even after the recent drop, which is massive. Tesla is still priced in as it is reporting gross profit of 150%, 147%, not 19%. So the damage in gross profits and the negative trend in gross profits has not been fully baked in the cake when it comes to the stock. So be careful here and word to the wise. Yes, the stock moved higher based on the gamma squeeze, but the fundamentals are getting really worse. Still impressive numbers, but the trend is negative and the stock has yet to fully price that in. Next, we have Southwest Airlines, another disaster here. Look at this, operating revenues up by 22.2% year on year, but operating expenses up by 35% year on year. And the reason is, look at this, stunning, absolutely stunning. Fuel and oil costs, the expenses in the last quarter, up by 51.1% year on year. Now, do yourself a favor. Look at what's going on in jet fuel prices year to date. You think that's going to be good for Southwest, for any airliner? Of course not. Salaries, wages, benefits up by 17% year on year. If fuel and oil costs don't go down, the only avenue for Southwest and other airliners to improve their margins is getting rid of employees. The problem is, with the demand still intact, at least for now, they can't do that. The only thing they can do for now is increasing ticket prices higher and higher and higher. But if we are talking about an environment where the consumer is getting weaker, then maybe soon enough that will be a no-go too. They're not going to be able to increase prices anymore because the demand demand by the consumer is moving down. What does that leave the company with if oil prices don't go down? Look at the net income. Stunning. Absolutely stunning. It went negative big time, and therefore the only avenue for Southwest Airlines and many other airliners, all of them, to be honest with you, if we see the consumer weakening and the demand for travel slowing down, but fuel expenses not moving down by a lot, the only avenue they got is to get rid of employees. Now, pilots will have some resiliency here because they had a really hard time finding pilots. They're still having a hard time finding pilots right now. But if you happen to be working the ticket booth, for example, or you happen to be a flight attendant at Southwest, you got to be worried a little bit here that maybe your job will be in the chopping block next. Now, what about ADM, a company that I used to own, and maybe we should own it again? We'll see what happens. Here's the report for ADM. Revenues up by 13.6% year on year. The problem is expenses up by 14.12% year on year. The operating margin is 4.62%. That is up from last year's 4.37%. It's not the best operating margin, but in this kind of business, this is good. All in all, net earnings are up by 30.30%, so the bottom line up big year on year. So why didn't the stock react positively? The answer is we have changes in working capital. When we look at the cash flow statement, that went down negative big time. And on top of that, the geniuses that they are, they spent about $1.4 billion in share buybacks, which is an absolute waste of time, absolute waste of money, and therefore the cash flow went negative by $421 million. So we have a cash flow problem with the company. And the question becomes, will we see a slowdown in revenue growth since grains prices are going down? We know that's good for the expenses, but the question becomes, what is the sustainability of the company's pricing power? Because if that diminishes, then the reduction in expenses will be a slow process. In the meantime, the margins of the company will be under pressure. So for now, the numbers look good, but the problem is I'm not seeing something that tells me, go ahead, buy the stock right now. I'm not seeing something that is popping out right now. Maybe if the stock price go down by a little more, then it will become more attractive. But for now, this is in the category of wait and see. Next, what about Valero, another name that I own in my portfolio, and this happens to be one of the best earnings reports that I have seen in a long time. Look at these numbers. This is not a technology company, folks. This is an oil refiner. The revenue's up by 16.27%. The cost of goods sales up by 9%. Right off the gate, revenues, the growth rate in revenues, I should say, exceeding the growth rate in the cost of goods sales. When it comes to expenses, look at the general and administrative expenses. Unlike the tech cohort where we have a problem, this expense actually went down by 1.4% year on year. When you have your revenues exploding, expenses actually going down, the operating margin is 10.28%, up from last year's 4.43%. And no wonder why the bottom line, the net income, up by a stunning 191.17%. That's cha-ching, baby. That's money right here. And the beauty of all of this, the shortages in refineries will still be with us. Oil prices, diesel prices, moving higher, at least in the month of January. The stock price, not overvalued at all. It's actually moving down. It's giving you the opportunity to hop in and move higher with the stock. But if you are seduced with NVIDIA and Meta and Carvana, have at it, my friends. The real money is right here. The real growth is right here. And I've been talking about this stock for almost a year now. Now, what about Blackstone, a name that I happen to short not long? Now, this is a stock that went up big year to date, and it continued to move higher after the earnings report. So am I wrong here in my thesis against Blackstone, or is this just another stupid short/gamma squeeze? Let's see the numbers, and here it is. Woo. Look at this. Revenues down by 70.43% year on year. Bruh. Now, expenses are down by 57% year on year, but hey, that is a drop in the bucket when we look at revenues down by over 70% year on year, and the net income down by 75% year on year. Oh my God! Do I need to say any more here? You have customers wanting to withdraw their money from all of these funds of Blackstone. Blackstone is refusing to allow any withdrawals because they know that the dam is going to break. This is a major problem absent of the Fed rescuing, keyword rescuing, Blackstone by stopping interest rate hikes, which is not foreseeable, by the way, because inflation is not going down as much as the Fed would like to see. And the underlying conditions of inflation are still with us. So we could see interest rates moving north of 5%, even north of 6%. That would be a major problem for Blackstone. If anything, my short thesis is validated. Now here's another name, Visa, that's doing pretty good. It's not a bad report at all, but we got some problems here. Not major ones, not immediate ones, but it could be a problem down the road note as we continue to see the consumer getting weaker. The net revenues for Visa up 12% year on year, pretty good. The problem is operating expenses up by 25% year on year. The net income, the bottom line, positive by 6% year on year, no problem here. But here's the problem, folks. Expenses are rising significantly higher. Now, this is not a problem for Visa right now because they're charging more and we have the payment volume increasing and therefore revenues are moving higher and the gap between revenues and expenses, well, it's large enough, so not a problem for now. But if we see the consumer getting weaker and the net revenue growth starts to slow down, but expenses not doing the same, you put two and two together, what can Visa do to increase revenue? There's nothing they can do. The only thing they can do to improve margins is to get rid of employees to reduce expenses. So here's yet another company. If we continue to see a slowdown, a more weakening of the consumer out there, it's going to be a problem for Visa and they have to get rid of employees. And this is perhaps the worst earnings report I have seen in my entire career. Folks, I have covered thousands of earnings reports throughout the years. This stands out. Perhaps the worst earnings report I've ever seen. Intel. Honestly, they should have just had one page that says, "We f***ed up." And this is what they tried to do because right off the gate, when we look at the different segments, client computer group, for example, they say revenues down by 36%, operating income down by 82%. Wow. And look at the operating margin, by the way, 11%, but it is down from last year, I should say, which was 37%. Stunning. Absolutely stunning. When we look at data center and AI group, revenues down by 33%, operating income's down by 84%. Wow. And the operating margin is down from last year's 37% to now only 9%, barely even keeping any money. When we look at network and edge group, revenues down by 1%, operating income down by 84%. And the operating margin down from last year's 17% to only 3% right now. You put it all together. Revenues down by 32% for the year. Expenses up by 3%. You see what's going on here? No wonder why the operating margin is down big. From last year, 24.3% to negative 8.1%. Think about that. Down 8.1%. The company's not making money. And folks, we're not talking about a hot dog stand here. We're talking about Intel, one of the biggest corporations in America, which, by the way, we're handing out billions and billions of dollars of taxpayer money, which is stolen from the taxpayer, and we're giving that away to this company? Well, how about you earn that money first? How about you show us that you're getting your house in order, Intel, before you start robbing the taxpayer? Anyhow, the net income, or lack thereof, down a stunning 114%. Wow. Oh no! What an embarrassment. If I was the CEO right now, I'll just resign. This is unacceptable at all. No wonder why Intel crashed after earnings, even though the technical setup was pretty good. Now, what about American Express? Because they say that Amex doing pretty good, the wealthy consumer doing pretty good, but the devil is always in the details. What contributed to the rise in payment volume for American Express in the last quarter? Was it coming from the baby boomer consumer? No, the share of baby boomers went down from 36% to 33%. Was it Gen Xers? Nope. The share went down from 38% in 21 to 37% in 22. The majority of the billing came from millennials and Gen Zers. Their billing share in Amex went higher from 26% to 30%. Now, there's a problem with that because we know that millennials and Gen Zers don't have the net worth or the discipline in spending that perhaps older generations have. And therefore, not alarming for now, not a problem for now, not even close. But we see the card member loans with 30 plus days past due increasing higher. My hunch is, Amex doesn't break this up, but my hunch is the majority of the increase is coming from millennials and Gen Z customers. Now, here's the real problem with Amex. We will look at the non-interest revenues up 14% year on year. So we're seeing some spending here. The spending is pretty good for now. When we look at interest income, interest rates are moving higher. That is up 65% year on year, but it is a small segment when we talk about non-interest revenues versus interest revenues. Now, when we look at expenses for the company, they were up by 15% year on year, so exceeding the growth rate of non-interest revenues. That is a problem, and the problem is illustrated right here. The net income, the bottom line, down by 9% year on year. Was the move in American Express up 10-11% after the report came out? Was it merited or not? My opinion is it was not. Why is the net income negative in Amex? The answer is, when we break down expenses, the category of card member rewards went higher by 23%. Card member services went higher by 32%. So right right off the gate, Amex has a problem. They might need to cut some rewards. Maybe they're spending more to attract the Gen Z and millennial consumer, but the cost is too much here. So don't be surprised if your benefits go down in Amex. Another problem for the company when it comes to expenses, how about the classic one? Salaries and employee benefits up by 23% year on year. Now, the beauty for Amex versus other companies, they have a lot of avenues here in cutting expenses. They can cut member rewards, for example, but the consequence could be pissing off card holders. They can cut card member services, but the consequences would be the same. You can piss off your card holders. They don't see the benefit of having an Amex card anymore. Or you can cut your headcount. Because the problem with the company having negative net income for now, can they increase the revenues? The answer is, it's not really up to them. It's up to the consumer. Will the consumer go out there and spend in the next few quarters? Well, the assumption, if you happen to be the manager of this company, I cannot rely on that. I cannot say when we have the assumption, the base case that we have a global recession, at least a slowdown coming. I cannot put all of my eggs in one basket that all the consumer is going to continue to spend. So what I have to do as a manager right now is get expenses in order. Am I going to cut members' rewards right now? Maybe a little bit. Am I going to cut card member services? Maybe a little bit. But am I going to cut some salaries and employee benefits if I don't see the use of these employees? Absolutely yes. So that is a problem in the tsunami of layoffs. And by the way, look at expenses for Amex. You see marketing, see that category, marketing? Well, that was down 20% year on year. Are you watching this? Google, Alphabet, Meta? The advertising business is in a recession. Companies are cutting down marketing expenses because that's easy to do. And the next step becomes cutting employees' salaries. And if that doesn't work out, then they have to cut rewards and services. Now, the last earnings report that we got last week is from Chevron. Let's do that. And what do we see here? Revenues up by 17.33% year on year. Costs up by 13.41% year on year. So the rate of growth in revenues exceeding the rate of growth in expenses. So far, so good. The net income is up by 25.5% year on year. Why is the stock down? It went up by a lot. So it's pulling back. It's giving you the opportunity to get back in. The problem is you have a lot of choices when we talk about big oil companies. You can buy Exxon, which is reporting this week. You can buy Chevron. You can buy BP, Shell. So you have to look at these numbers right now that I'm showing you and compare it with Exxon, compare it with BP, and see which company is doing better. Because when it comes to the upstream category for Chevron, up 6.40% year on year, the problem is in the United States, down by 11.85% year on year. This is the only problem I see with this report. When it comes to the downstream category, up by 133% year on year, no problems here. Up in the US, up in internationals, no problems in this segment at all. So again, if you're looking to buy some big oil company, big oil stock in your portfolio, you don't have to do it right away. You got Chevron out of the way. Look at these numbers, whether you like them or not, but you got Exxon coming. Wait till you see Exxon. Wait till you see BP. Wait till you see Shell, for example. But you can also wait and see what the refiners are going to do, because Valero is doing a lot better than Chevron. Marathon Petroleum reporting earnings this week. Maybe it's going to go down after a decent report. So as an energy investor, you're going to have the shopping window right now. You can look at the refiners, you can look at oil companies, you can look at gas companies, you can look at services companies and make the proper decision. And the beauty of all of that is all of these oil stocks, energy stocks are pulling back. So this is the time for the shopping season. You don't have to rush. Look at these reports, find the companies you like, and then pull the trigger accordingly. But folks, with this out of the way, this is all the coverage that I got for you for week number 2 in earnings reviews. Hope you enjoyed the coverage, and we're going to do more of that for week number 3, no doubt about it. Anyhow, folks, once again, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again soon. Take care.
We're just getting started.
Still got crack. Yeah. Still got crack. Still got crack. Still
uh.